Imagine walking into a room with 10 strangers. You pitch your dream idea, and if you play your cards right, they might hand you millions of dollars to make it real. Sounds like a movie scene, right? But this is how venture capital firms invest in startups. The real question is, how do they decide which ideas get the money and which ones get a polite no thanks? Stick around, because by the end of this video, you'll understand exactly how venture capital works and why it can turn a small garage startup into the next billion-dollar company. Number 1. What is venture capital really? Let's strip it down. Venture capital, often called VC, is money invested in young, fast-growing businesses. These are usually startups that have big dreams but don't have the cash to make those dreams real. Venture capital firms pool money from investors, like wealthy individuals, pension funds, or even universities, and then place bets on startups they believe could explode in value. Think of it like Shark Tank on steroids. Instead of one or two investors writing checks, you've got entire firms managing billions of dollars looking for the next big thing. Example: Google, Facebook, and Uber all had venture capital backing before becoming global giants. Without VC, they may never have scaled at lightning speed. Number 2. Why do startups need venture capital? Startups often face a chicken and egg problem. They need money to build their product, hire talent, and grow fast. But without growth, they can't make money. Banks usually say no to risky startups because they want collateral and proven revenue. That's where VC firms swoop in. VCs don't ask for monthly repayments like banks. Instead, they buy a piece of the company. If the startup succeeds, that piece can be worth 100 times more later. Example: imagine you start a new delivery app and need $2 million to hire drivers and market aggressively. A bank won't risk it, but a VC might, because if your app becomes the next DoorDash, their small investment could be worth billions. Number 3. How do venture capital firms find startups? Venture capital firms are always on the hunt for the next unicorn, which is a startup valued at over $1 billion. They scout talent at universities, tech conferences, startup competitions, and through networks of entrepreneurs. Founders also reach out directly by pitching their ideas through a business plan or pitch deck. If the idea stands out, the VC will invite them in for a deeper conversation. Example: Dropbox, the cloud storage giant, started after its founder demoed a simple video of how the product worked. A VC saw the potential and invested early. That small bet turned into a massive success. Number 4. The stages of VC funding. Startups don't get all the money at once. VC investments usually come in stages. First, you've got seed funding. This is the earliest money, just enough to get the idea off the ground. Think of it as planting the seed of a business. Next is Series A. This is when the startup has shown some traction, maybe users or revenue, and needs capital to grow. Then Series B, C, and beyond. Each round means more money, higher valuations, and bigger bets. By the time a company reaches Series D or E, they're often preparing for an IPO or initial public offering when they go public on the stock market. Example: Airbnb started with a tiny seed round to test its idea of renting out air mattresses in apartments. By the time it reached later rounds, it had raised billions and became a household name. Number 5. What VCs look for in startups. Here's the big secret. Venture capital firms don't just look at the product. They look at the people. Strong, passionate founders who can execute are often more important than the idea itself. They also want a massive market. A startup solving a problem for 1,000 people won't get far. But if it can serve 100 million, now that's exciting. They analyze the business model too. Can it scale? Is it unique? Will it crush competitors? Example: when VCs invested in Zoom, video calls weren't new. But Zoom had a product that was easier, faster, and worked better than others. That unique edge made investors pour in cash. Number 6. The due diligence process. Before writing a big check, VC firms don't just take the founder's word. They dig deep. This is called due diligence. They look at financial statements, customer feedback, competitor analysis, and even background checks on the founders. It's like a detective investigation. They want to be sure they aren't throwing money into a scam or a weak idea. Example: in 2014, A blood testing startup called Theranos tricked some investors by hiding flaws. Many VC firms passed after doing due diligence, but those who didn't lost hundreds of millions. This shows why due diligence is critical. Number 7. How much ownership do VCs take? Venture capital firms don't give money for free. In exchange, they take equity, which is ownership in the company. Depending on the stage and amount invested, they might own 10%, 20%, or even more. That means if the startup sells or goes public, the VC makes money based on their share. Example: when Facebook went public, one of its early VC investors, Excel Partners, turned a $12 million investment into billions of dollars. Number 8. The power dynamics between founders and VCs. Here's where it gets interesting. Taking VC money isn't just about getting cash. Founders also give up some control. VCs often get a seat on the company's board, meaning they help make big decisions. This can be great because VCs bring experience and connections, but it can also cause tension if founders and investors disagree. Example: at Uber, early investors pushed out the original CEO, Travis Kalanick, when the company faced scandals. That shows how VCs can influence leadership. Number 9. How VCs make money. VC firms have one main goal: to multiply their money. They know most startups fail, so they spread their bets. If they invest in 10 companies, maybe 7 will fail, 2 will break even, but 1 could become a billion-dollar unicorn. That one success can cover all the losses and deliver massive profits. Example: a 16Z, a famous VC firm, invested early in Instagram. They sold their stake to Facebook for around $78 million. That return alone justified their bet, even if other investments failed. Number 10. What happens when startups exit? VCs only make money when startups exit. An exit can be through an IPO, when the company lists on the stock exchange, or through an acquisition, when a bigger company buys them. Example: when Microsoft bought LinkedIn for $26 billion, LinkedIn's early VC investors made fortunes. Number 11. Risks of venture capital. For founders, VC funding sounds glamorous, but it comes with risks. Giving up ownership and control can backfire. If growth slows, VCs may push for aggressive changes. For VCs, the risk is losing money. Studies show that about 75% of venture-backed startups fail. That means VCs must be very selective. Example: Juicero, a fancy juicing machine startup, raised $120 million from VCs but collapsed because consumers realized they didn't need the expensive machine. That's a reminder of how risky the game is. Number 12. The impact on the economy. Venture capital is a driving force for innovation. It funds technologies we use every day, from smartphones to electric cars. It also creates jobs, boosts industries, and shapes the future. Example: Tesla wouldn't have scaled without venture capital. Today, it's not only a car company, but a leader in clean energy, inspiring industries worldwide. Number 13. Should every startup chase VC money? Not always. Venture capital is great for startups aiming to grow fast and dominate markets. But for small businesses that want steady growth, bootstrapping or bank loans might be smarter. Example: Basecamp, a software company, rejected VC money and grew profitably on its own. They chose independence over speed. Number 14. The role of limited partners. Behind every venture capital firm are the people who provide the money. These are called limited partners, or LPs. They can be pension funds, insurance companies, wealthy families, or even governments. LPs commit their money to a venture capital fund for several years. The VC firm then manages that money, decides which startups to back, and hopefully delivers profits back to the LPs. Example: a university endowment may invest hundreds of millions into a VC fund. If that fund backs a winning startup like Stripe, the endowment grows, which then supports scholarships and research. Number 15. The role of general partners. Inside a VC firm, the people making the big calls are called general partners, or GPs. They scout startups, negotiate deals, and often mentor the founders. GPs usually have backgrounds in business, tech, or finance, and they use their expertise to spot opportunities others might miss. Example: Peter Fenton, a general partner at Benchmark, invested in Twitter when it was still tiny. That decision turned into a massive win for his firm and for him personally. Number 16. Follow-on investments. VCs don't just invest once and walk away. If a startup shows promise, the same VC may invest again in future rounds to protect their share and support growth. This is called a follow-on investment. Example: Sequoia Capital invested in WhatsApp multiple times as the app grew. When Facebook bought WhatsApp for $19 billion, Sequoia walked away with billions in return. Number 17. The concept of runway. One term you'll hear in venture capital is runway. Runway is how long a startup can operate before running out of money. If a startup raises $5 million and spends $500,000 a month, they have 10 months of runway. VCs always check runway because it shows whether a company needs another funding round soon. Example: many startups that ran out of runway in 2020 during the pandemic had to shut down or accept emergency funding on tough terms. Number 18. The importance of scaling. Venture capital money is not meant for slow and steady growth. It is meant for scaling. Scaling means growing fast without the costs rising equally fast. VCs want to see that a startup can expand to new markets, serve more customers, and increase revenue quickly. Example: Spotify scaled from Sweden to the entire world in just a few years, thanks to VC funding that allowed them to handle millions of users at once. Number 19. Convertible notes and safe agreements. Not all VC deals are straightforward equity trades. Sometimes, early-stage investments use tools like convertible notes or safe agreements. These are ways to give startups money now, with the promise of turning it into equity later when the company sets a valuation. Example: Y Combinator, the famous startup accelerator, often uses safe agreements to invest small amounts in startups, which then convert into equity during bigger funding rounds. Number 20. The role of accelerators and incubators. Before VCs step in, many startups go through accelerators or incubators. These programs provide mentorship, small amounts of funding, and networking opportunities. VCs often watch these programs closely because they act as a filter for strong ideas. Example: Airbnb went through Y Combinator, and the mentorship there helped them refine their model before raising millions from VCs. Number 21. The global spread of venture capital. Venture capital used to be concentrated in Silicon Valley, but today, VC is global. Startups in Asia, Africa, and Europe now raise billions. This global expansion means opportunities are everywhere, not just in the USA. Example: Grab, a ride-hailing and delivery app in Southeast Asia, raised huge amounts of VC money and became a regional giant, similar to Uber. Every great company starts with a spark, but it's the fuel of venture capital that can turn that spark into a wildfire. The world we live in today, from the apps on our phones to the cars on the road, has been shaped by VCs taking risks on bold ideas. But here's the question for you. If you had millions to invest, would you play it safe, or would you take the risk of betting on the next big startup?